Picture a billionaire walking up to you at a party. He's holding something he swears is the deal of the century. He tells you it could change your life, that people like you never normally get a shot at this, and that he's letting you in purely out of the goodness of his heart. You'd be suspicious, wouldn't you? You'd wonder what he actually knew, and yet that's roughly what's happening across the entire stock market right now, on a scale we've almost never seen, and most people are treating it like a gift instead of a warning. The biggest companies in the world are suddenly desperate to hand you a slice of themselves, and the sales pitch is beautiful. This is your moment. The future is being built right now, and for the first time, ordinary people get to own a piece of it. But sit with it for a second. When someone who knows a business inside and out decides to sell part of it, they need somebody on the other side willing to buy. And when a company first sells its shares to the public, the sellers aren't strangers. They're the founders, the employees who spent a decade of their lives there, the investors who backed it when it was 2 people and a laptop. Nobody on the planet understands what that company is really worth better than they do. They've seen every number, every projection, every problem you'll never get to look at. And after all that, they've decided that today, at this price, they would genuinely rather have your money than keep holding their own shares. That's the strange thing hiding underneath all the excitement. The person selling knows almost everything. The person buying knows almost nothing. And right now, the person buying is you. So let's start with the thing nobody wants to say out loud. Professionals don't sell when things look bad. They sell when things look perfect. The average person does the opposite. They sell when they're scared, when the news turns dark and the chart is falling and everyone around them is already running for the exit. Benjamin Graham, the man who mentored Warren Buffett and more or less invented value investing, described the smart investor as someone who sells to optimists and buys from pessimists. You get the most money for something at the exact moment the story around it is loudest, and the line of buyers is longest. And that's not a theory. It's a pattern you can watch in the data. When markets are booming, companies rush to go public. When markets turn, those same offerings quietly disappear, which raises an uncomfortable possibility. The moment the doors open the widest might be the moment the people who know best are most eager to leave. Let's rewind to June 2007. Wall Street was at a peak. Credit was cheap, deals were everywhere, and one of the most respected private equity firms in the world, Blackstone, decided it was the perfect time to sell shares to the public. The IPO raised over $4 billion. Its 2 founders walked away with staggering sums. Peter Peterson, who was preparing to retire, cashed out around $1.9 billion. His co-founder, Steven Schwarzman, sold hundreds of millions more while keeping a large personal stake. And here's the part that matters. Schwarzman later said on the record that he pushed for the IPO because, in his words, he just felt something bad was going to happen. He wanted to be prepared for the nuclear winter. Listen to that again. The man selling shares to the public said he did it because he sensed a storm coming. A little over a year later, the global financial crisis hit. Blackstone's stock, which listed at $31 a share, collapsed to under $4, roughly a 90% decline. The founders sold at the top, the public bought the top, and the man on the selling side had all but told everyone why. Now, this isn't a story about one firm getting lucky. It's a pattern that shows up again and again right before the air comes out of a market. Go back to the dot-com bubble. In the years leading up to the crash, the number of companies going public exploded. In 1999, the year before it all unraveled, technology made up around half of every company that went public. Everyone wanted a piece of the digital future. Then, the year after all these companies listed, after the insiders had cashed out and the public had bought in, the bubble burst. Over the next 2.5 years, the Nasdaq fell more than 75%. Trillions of dollars in value simply evaporated. It took 15 years for the index to climb back to where it had been. And most of the companies that sold you stock on the way up never made it to the other side. A study tracking companies that went public in the late 90s found that a decade later, only around 3 in 10 were still standing as independent public companies. The thing people thought they were buying no longer existed. The insiders were long gone, and they'd taken the cash with them. Then, in 2021, the same story showed up wearing a brand new costume. This time, it was called the SPAC, a company that goes public before it's even a real business. You raise money from investors first, list on the exchange, and only then go shopping for an actual company to merge with. An empty shell with a checkbook, which is exactly why people called them blank check companies. The appeal was that it let a private company reach the public market while skipping much of the scrutiny of a traditional IPO. And the money came flooding in. In 2021 alone, hundreds of these blank check companies went public and raised more than $160 billion. For a stretch, they made up more than half of every new listing hitting the US market, and the ending writes itself. Companies that completed one of these mergers in 2021 lost on average well over half their value. and the activity collapsed almost overnight the moment the enthusiasm faded, falling from hundreds of deals to a small fraction of that the very next year. Same pattern. Insiders sell into the excitement. The public is left holding what's left when the excitement fades. Which brings us to now, to AI, and to a question worth sitting with. Why now? Why are the most valuable companies in the world, fierce rivals who agree on almost nothing, all suddenly interested in selling stock to the public at the very same moment? Part of the answer comes down to two numbers. The first is how much is being spent. This year, the largest technology companies on Earth are on track to spend around $725 billion building out artificial intelligence. That's up roughly 77% from the year before. It is, by a wide margin, the largest and fastest infrastructure build-out in corporate history. That number is almost impossible to picture. So here's one way to feel it. If you spent $1 million every single day, starting from the year Jesus was born, through the fall of Rome, the Middle Ages, the Renaissance, both world wars, right up until this very moment, you still would not have spent what big tech alone plans to spend on AI in a single year. It works out to somewhere around $2 billion a day. That's the money going in. Now here's the second number, the one that gets talked about far less. What all that spending is actually earning back. Because when researchers try to add up the entire AI economy, all the revenue from all the companies actually selling AI products, the figure comes out to a fraction of what's being poured in. And revenue is not profit, it's just money coming through the door before any costs. Put those two numbers side by side, hundreds of billions going in, a small fraction coming back out. And it isn't just the tech giants. When one major consulting firm surveyed thousands of business leaders, they found that while nearly 3/4 of organizations wanted AI to grow their revenue, only about 1 in 5 had actually seen it happen. A separate study from MIT looked at hundreds of real company AI rollouts and found that the overwhelming majority produced no measurable return at all. So the gap between what's being spent and what's being earned isn't a small one. It's enormous. And the market has so far priced these companies as if that gap doesn't exist. Take OpenAI, sitting right at the center of the storm. It's still private, but its financials have leaked and it has filed confidentially to go public. So the picture is clearer than it's ever been. Last year, the company brought in around $13 billion in revenue. Genuinely impressive growth, more than tripling from the year before. But here's the other column. Its operating loss for the year was around $21 billion. You'll see an even bigger headline figure floating around, a net loss of $38 billion, but a large chunk of that is a one-time accounting charge from the company restructuring itself. So the fairest number to focus on is that roughly $21 billion operating loss. Either way, the direction is the same. The company spent far more than it earned, and the gap has widened every year since it was founded. And despite that, its most recent funding round valued it at around $850 billion, more than 60 times its revenue. This isn't a bet on whether it's a good company, it's a bet that the future arrives exactly as promised, with almost no room for disappointment. There's something worth pausing on here because it's the part that makes this moment genuinely unusual. Normally, companies compete. They guard their secrets, they undercut each other, they disagree about almost everything. But when it comes to selling stock into this AI wave, the biggest players are moving in remarkable unison. Rivals who spend their days trying to destroy one another are all at once deciding this is the right moment to bring the public in. And when fierce competitors suddenly agree on something, it's usually worth asking what they can all see that you can't, because they're not coordinating out of generosity. They're each responding to the same set of facts. The spending is enormous and still accelerating. The returns so far are thin, and the valuations assume a future that hasn't arrived yet. Every one of them is looking at the same widening gap between what's being poured in and what's coming back out. And every one of them has reached the same quiet conclusion about what to do while the enthusiasm is still high. There's a second thing driving the timing, and it's less about greed than survival. Building AI at this scale costs almost unimaginable amounts of money, and that money has to come from somewhere. Private funding, even at these staggering sums, has limits. The public market doesn't, at least not in the same way. It's the deepest pool of capital on the planet, filled with pension funds, index funds, and ordinary people who will keep buying as long as the story holds. So for a company burning tens of billions a year, tapping that pool isn't just attractive. At some point, it becomes necessary, which means the very hunger for cash that's driving these companies to sell is also a signal about how expensive the race has become and how uncertain the payoff still is. And that that brings us to maybe the most honest thing anyone in finance has ever said out loud. In the summer of 2007, just months before the financial system nearly collapsed, the head of one of the largest banks in the world was asked why his bank kept dancing along to risky lending even as the warning signs piled up. His answer became infamous. As long as the music is playing, he said, you've got to get up and dance. We're still dancing. Think about what he was actually admitting. He wasn't saying the party would last, he was saying the opposite. He knew it would end. He was saying that as long as the money kept flowing, he was going to keep dancing anyway. Because whoever was still on the floor when the music stopped would be the one who got hurt. It was a giant game of hot potato, and the only thing that mattered was making sure you passed it on before the lights came up, which is almost exactly what you're watching now, except the potato is a share in a company priced for perfection. The players are the founders and the insiders, and every one of them knows that eventually someone gets left holding it. So let's go back to the question we started with. If these really are the most valuable companies in the world, and the future is as bright as everyone keeps promising, why are the people who understand them beast in such a hurry to sell? And the uncomfortable answer is simply that it may be the smart thing to do. The people running these companies aren't foolish. They can see the same gap you can. They can see that prices have sprinted well ahead of the fundamentals, that the market has priced in a future where every bet pays off perfectly. And they're in the middle of an arms race that demands enormous amounts of cash. So whoever sells first gets to sell into the hungriest crowd of buyers there is. It doesn't actually matter in the short run whether these companies turn out to be good or bad. The price already assumed they'd be great, which leaves very little room for good news and an enormous amount of room for disappointment. Nobody can tell you when. Anyone who stares into a camera and hands you a date is guessing or lying. The fundamentals might take a month to catch up, or a year, or 3. These companies might climb much higher before any of it matters. That part is genuinely unknowable, but you don't need the date. You just need to be able to read the room you're standing in. And right now, the room looks like this. The doors are open wider than they've been in years. The people who know these businesses best are walking toward the exit with their arms full, and a very enthusiastic crowd is rushing in the other direction, certain that this time is different. It usually feels different. It rarely is. So the next time someone offers you the opportunity of a lifetime, it's worth remembering the one question underneath it all. Not, is this a good company? But why exactly is the person who knows it best so eager to sell it to you?